Are you somebody that's looking for two great stocks to add to your portfolio right now? Well, in this video, we're going to be covering a brand new Canadian stock to the channel, as well as a really awesome US one to look into. Enjoy. What's going on, you guys, and welcome back to the channel. If it's your first time here, my name is Brandon. As always, you can learn more about our investing academy with that first link in the description below, or you can visit us at www.theinvestingacademy.ca. In today's video, we have another episode of our two stocks to buy right now series, and we're going to be diving straight into the Canadian selection. I want to say that this is a brand new Canadian stock to the channel, but I'm not 100% sure. If you guys enjoyed this video, all I ask is you drop a quick thumbs up, and without wasting any more time, let's jump on into the first stock, which is the company Rogers Communications. This is the Class B share that we're looking at. The ticker is a bit of a unique one. It's RCI.B, and this one trades on the TSX. And what really sparked my interest in the company Rogers here is that if we look, they're down about 25% off highs. And we are seeing a very nice dividend today of 3.71%. And Rogers, as we all very well know, this is our wireless provider. This is our internet, our cable television provider. They are the largest service provider here in Canada. And when we talk about Rogers, obviously we're talking about Rogers and Fido and Chatter. They have a number of subsidiaries under their umbrella. But across the country, this is even as of last year, 2019 annual report, they have over 10 million wireless subscribers, a major customer base. And if we do dive a little bit deeper into their income breakdown and take a look at their revenue streams, you will see that the wireless component is really the main driver of this Rogers business. 61% of their revenues derive from wireless. Cable comes in at the second largest component at about 26%. And then media, which is the smaller component at 13. To me, this is very important. This would comprise of things like Sportsnet, for example. They own Sportsnet. They own the Blue Jays, which was a fun year for them, but didn't really show up in the playoffs. They own the Rogers Center, of course. That's kind of where it gets its name. And even a fun little fact, they have the rights to the NHL. This goes through to 2026. So Rogers, as a wireless company, does have these media outlets, and I actually think that's a very important area for their diversification going forward. Like I mentioned at the top of this video, although Rogers is a new stock to the channel, we have very closely covered its competitors. We've covered Bell, as you know, is one of my favorite companies. We've covered TELUS. We've covered Shaw. And just today, if we were to kind of compare how Rogers is sitting amongst its close peers, I was actually liking the valuation metrics. And you take, for example, I've highlighted a few here, but we could start, for example, with the dividend yield. The dividend yield is below currently Bell and Shaw at 3.71 versus 5.9 and 5.0. Still, nonetheless, a very, very attractive yield at 3.7%. But we do see a pretty significantly lower price to earnings ratio. So a 13.2 versus a 17 and an 18. Even if you look up at a price to sales metric, for example, 1.8 versus 2.1 and 2.2. To me, what this details is that if you are looking for some exposure into this telecommunication space, into this internet provider sector, which you don't have in your portfolio, as of current day, Rogers may be looking at a slightly more attractive option. If we were to take a second and look into their numbers, maybe look at some income numbers here to see why the stock is down 25%. If you do notice at the very top line, at the revenue at the top, we do see that they have kind of stalled out in the sense that this is not a rapidly growing company, but through 2018, 2019, 2020, we have seen actually a decline. It seems to have kind of peaked up at about 15 billion. Trailing 12 months has dropped down. COVID may very well be playing a part in that. But what I do really like and what I think is very promising about this is that although the revenues haven't been growing like crazy, we have seen their net income. The bottom line has slowly increased. So we see the operating margin expanding over the past number of years, resulting into a bigger, better bottom line with more money pulled in at the end of the day, which essentially tells us that the company is operating more efficiently. Dividend is obviously a massive component with Rogers, and we can keep this very, very simple. They're not growing it aggressively, but it's a very consistent dividend payer. 16 years of growth. You see the numbers that they're growing it by are not massive, but for a company in this space, in a bellwether sector, this is one of those services, this is one of those products out there that people have an ongoing need for. And here in Canada, there really aren't a crazy amount of providers, or I shouldn't say that. There are a lot of providers and a lot of new companies up and coming, but it's these big players at the top that kind of control the whole area. And because they have such deep pockets, because they have such a presence, is really a very interesting mode in this space. When a new company comes up and they're gaining some traction, they can just be bought out by the big companies. And we see that all the time. That's why I think a company like Rogers or TELUS or Bell, regardless of who you're looking at, because they have these massive user bases and they have these customers that pay every month or every year for their services, it's a very, very stable, it's a very, very reliable company, which results again in obviously great dividends, and the share price has actually done quite well. This is a really good performer over the long term. Today, like I said, the shares are down 25%, but to me that actually piques my interest because we can go out and get our hands on this stock for today $54 Canadian and pull in the 3.71% dividend. Now, before diving on into the US selection for today, I want to take a brief moment and give a massive thank you and a massive shout out for today's video sponsor, and it is the company HelloFresh. This is Canada's most popular meal kit solution. And I honestly could not be more excited to be doing a deal here with HelloFresh. I've got with me the cheesy stuffed meatball. I don't know how well you'll be able to see this, but I'm filming this video this morning and I cannot wait to get home and cook this up for lunch. HelloFresh offers these simple, stress-free cooking solutions. They're pre-packaged, they're delivered straight to your door. For me personally, there's not much that I wouldn't eat, but what I do like about HelloFresh is that they give you a wide variety of options. And if you have these dietary restrictions, you can basically tell them what you want and they'll send you these pre-packaged. It's got all the ingredients cut up, all the sauces, perfect serving sizes, and then you just follow the steps and cook it. For anybody that likes the idea of convenience, for anybody that likes delicious food, because these meals really are delicious, I truly mean that. For being the sponsor of today's video, HelloFresh is willing to offer 80% off if you place an order with the link down below, with free shipping included. So I'll put a link down below. You can also use the custom code. It's INVEST80 and you'll get 80% off your first order plus free shipping. Thank you guys for making this video possible. And if you're looking for some good food, look no further. Moving along into the second stock for today's video, this is our American selection and it is one that we've covered before on the channel, but let's dive straight on into it. It is the company Cisco Systems. The ticker for this one is CSCO. And as you can see, this stock does trade on the NASDAQ. This is a share price that to me, I always find fascinating. As you see this massive spike going back about 20 years ago. Cisco, as a fun fact, guys, was actually at one point the largest company in the world. With the rise of the tech stocks, with the tech boom, all these overinflated prices, this is in the 1990s leading up to the 2000s, Cisco, again, this goes back a number of years, was the largest company in the world. You see today, we actually haven't broken those highs, but I don't think that should take anything away from Cisco as a company. In fact, in this video, in this segment, we're going to talk about how sustainable they are and how they may fit your portfolio in a very unique way for the tech exposure. But let's start off with the dividend with Cisco. This is one thing that I absolutely love. Today, we're looking at a dividend of 3.56%. And if we flip over to some of these metrics, looking into the dividend a little bit deeper, you'll see that Cisco is very aggressively growing their dividend. And we see double-digit growth on a 5-year number, on a 3-year number, been growing the dividend for a number of years. But that's because really, as we touched on in previous segments, Cisco is not at a phase where they are growing their business a whole lot. They're not, this isn't 1999 and they're rapidly expanding and growing. Cisco's kind of evolved into this more mature play. And really a big emphasis for them is paying out these dividends, really growing aggressively, the dividend payment. To kind of showcase this, if we looked into the numbers, kind of similar to Rogers, I have highlighted here the past 5 years. We haven't really seen any top line growth. The revenues have not been increasing. They've kind of hovered at this 49 to 50 billion range, let's call it 49 billion. But again, in another case, we do see the operating margins expanding. So from the low 20s up to today, we're looking at 28.6%, which has resulted in net income slowly and gradually increasing. And to me, it's actually a very fascinating case where if you compare 2015 to 2020, we have identical top line revenue. So the money pulled in is exactly the same, yet they were able to make about $2.3 million more because essentially the company has gotten more efficient. This to me is a very promising sign if you look at the numbers with a company like Cisco. Another thing that I like about the company is that financially, I think they are very, very healthy. And this would be something where we can look into the balance sheet. If we do look at, I've got highlighted a couple here lines just in particular, very low amounts of long-term debt. And we see here about $11.5 billion in debt, which is a lot of money. But you take a look at the top line where they have $11.8 billion in cash alone and cash equivalents, very short-term access to money. If they wanted to, in theory, they could wipe this off. They never would do that. But this is not something you see every day with a lot of companies out there. A lot of companies are very highly leveraged. They're sitting with a lot of debt on their balance sheet. Long-term debt here, to me, this is a skookum balance sheet for a company like Cisco. Cisco, if you're not familiar with them, I would kind of categorize them as a technology conglomerate in the sense that they do have a lot of different products, and where I guess they're most famous for could be routers and switches. Now with the COVID lockdowns, one of the big platforms for them, and I've done meetings on this, and maybe you have as well through work or whatever, Cisco WebEx. They've really kind of got all sorts of products, technologies that they're working on. That's really, to me, the definition of a conglomerate, is they have a variety of things kind of driving business. Of course, 5G is a big play for Cisco going forward too. Even Rogers as well. We could call this our 5G special edition, as both of these companies are going to have their fingers intertwined. To me, Cisco is just, it's an alternative. Don't get me wrong. I'm not putting this in a category of the FANG stocks with the Amazons and the Apples and the Netflixes, because again, they're very different companies at very different phases, but this is still tech exposure, a different type of tech exposure. So rather than shooting for the growth stocks, which maybe you already own in your portfolio, maybe you own a bunch of Amazons, maybe you own a bunch of Apples or whatever the case is, or Googles, this is almost that other end of the spectrum where you have a 3.56% dividend, a very reliable one that's constantly growing, which just kind of gave you that backdoor exposure to technology. It may be a very nice complement to those high growth tech stocks. And what's great about a stock like Cisco is that because it's been overlooked, because it's not your high flyer stock nowadays, we're looking at actually a very reasonable PE. PE ratio of 15.3 for a technology company. I do understand they're not growing revenues like crazy, but as we saw, dividends growing at double digits. To me, this is a great play if you're somebody that's looking for the dividend growth and you're looking to grow and compound your dividends year after year after year, maybe even get a drip going and just constantly buy some more shares. Again, with a very important point, a very stable part of this analysis is a very healthy balance sheet. They've got a consistent line of business. They pull in a very consistent amount of money. Earnings are getting better and better due to increasing margins, and we don't really face the risk of them going bankrupt or anything. Again, that long-term debt of only $11.5 billion, very promising in my sign, and that's why I think a Cisco today is actually a very attractive stock to look into for the long term. Stock is down off of these highs about 28-30%, and this is a stock that I do own in my portfolio. Actually, I do own both of the stocks that we covered today. I own stake in Rogers, I own stake in Cisco, and these are both stocks that are high on my radar, stocks that I'm very much liking if I'm going to start adding more or deploying more money into the markets. A lot of stocks have done quite well in aggregate if you're just looking broad talks, but these stocks both are down 28% and then 25%. To me, that really piques my interest. You got some great dividends on both, and in my opinion, you're looking at two very healthy companies that are going to be around for the long term. If you guys enjoyed today's video and you enjoyed my thoughts, feel free to give this one a thumbs up, and you can let me know down below. Did you like the stock picks? Did you not like them? I'm all ears. Or do you guys even have some better stock picks? Leave a comment down below. If you are new to the channel and you enjoyed this video, I would say you definitely should subscribe, because we post this video all the time. usually once a week or so, whenever I'm seeing a couple good stocks that I really like. And then, as I mentioned at the top, if you are a beginner to the stock market, if you want to learn about our Investing Academy for courses, training, if you're just new and you're looking to learn this whole thing, click the first link down in the description below and you can learn more about becoming part of our community. We are working with Canadians every single day, hundreds of them, just taking them step by step through the entire process. And yeah, that's our Investing Academy. You can also visit our website. But that's all for today's video. I thank you guys all for watching. I hope you enjoyed, and I'll see you in the next video.